Okay, so let's begin. So the goal of this week is to complete the model, and then start to talk about valuation concepts. Valuation, by the way, is it's a completely different thought process. So it's kind of difficult to teach and to explain. Where this is very process oriented, valuation is almost a mindset. So we're going to slowly start to introduce that as we kind of go forward. But I do want to make sure you guys can model. It's the third week already. It's going by quick, and you guys should be able to at least have a first instruction as to build a full-scale model, and then we'll do more practice. So just to recap what we started talking about on Thursday, what is working capital? What is operating working capital? What is the difference? Make sure you know the difference. That's a test question. That's an often, and I put the question on the test because it's often asked of you guys at in investment banking interviews. But working capital is a measure of a company's current assets less its current liabilities. Right? Current assets is an asset is a resource who's expected to provide some sort of economic benefit to the company, and a current asset is a resource whose economic benefit should come within the year. So examples of current assets are cash, accounts receivable, inventory. Right? A liability is a debt or obligation on the business, and a current liability is a debt or obligation who's expected to come due within the year. Short-term debt is an example, accounts payable, liquid expenses. These are all current liabilities. So the idea of current assets minus current liabilities is a way of measuring how much cash is expected to come in the near term, and what do you have to, where does that cash have to be paid? What are the short-term obligations on that cash? That's working capital. So businesses have managers that manage working capital to help you determine how much cash is coming into the business, where it has to go in the short term. It's something that's important to manage. In modeling, we take a narrower definition of working capital that we call operating working capital. Operating working capital is your current assets excluding cash and your current liabilities excluding debts. So you're wiping out cash and debts. Why do you do that? Why do we care? If you wipe out cash and debts, what are you left with? Mostly in your current assets and current liabilities, you're left with AR, inventory, you're left with accounts payable, accrued expenses. These are all line items that are based on operations. So if you're a working capital manager and you see possibly a working capital shortfall, or your liabilities are greater than your assets, or you see something, you don't want the cash and the debts in the business or an infusion of cash to mask some sort of shortfall. You really want to track exactly what's coming in from your everyday operations just to assess if there's a need or if there's a potential issue that needs to be covered, that needs to be adjusted for. So you wipe out cash, you wipe out debt, and that leaves you with strictly operating working capital, the current asset and current liability line items that are backed by your operations. AR is based on revenue, right? Inventory is based on COGS. Accounts payable is based on COGS. We discussed all this Thursday, so I'm just going to read that. And we also talked about how do you perceive some of these line items. So we gave the example of accounts receivable. If accounts receivable is increasing, is that good or bad? We gave the example of if accounts receivable was $25,000 last year and then $50,000 this year. If it jumped by $25,000, is that a positive sign or a negative sign? What do you guys think? Depends. What does it depend on?
It's relative to sales.
It's relative to your sales, right? You cannot look at these line items on an absolute basis because an increasing accounts receivable could mean you have a collection problem. Right? Maybe customers aren't paying you, so it's just sitting in your balance sheet, stacking, you have a collection issue. That could be bad. Or maybe ARs are increasing because your business is growing, because your bottom line, your sales are increasing. So your AR increasing could be a good thing. So how do you determine whether a shift in one of these current asset or current liability line items is a positive or a negative? We need to look at it relative to the operations. We need to look at it as a percentage of the operations. And so we use this measure called days, right? So days just takes the percentage of operations and multiplies it by the number of days in a year. It's just convention, just to get an idea as to how many days in the year has this item been left outstanding? So I gave the example of, well, I gave 25,000 last year on Thursday, but let's say we have accounts receivable of 2,500 in a particular year. That's meaningless to us to a degree unless we compare it to the revenue that was generated in that year. So if we say that there was 10,000 in revenue generated in the year, that's 25% of our revenue. 25% of our revenue generated was left outstanding at the end of the year. We have 25% of the revenue generated still needs to be collected. So if you multiply that by the number of days in a year, and you can use 365 before accounting, a lot of times we use 360, basically because that's evenly divisible by 12. So if we ever want to break down our model into a monthly model, we don't have to do these adjustments because of February and because of 31 days versus 30 days. If you're building a model on a 360-day basis, you can just easily divide your everything by 12. And so if you multiply 360 times 25%, you get 90 days. So basically, 90 days of the revenue generated is left outstanding. It's a good measure if you compare that to what is realistic for you. A lot of times you expect the customer to pay you maybe in 30, 60, or 90 days. And if you're a working capital manager and you want your customer to pay you on a 30-day basis, then 90 days is a little too high. You need to adjust for that. It's also important because it helps you track year to year how this is doing. Is this number improving or is this number not improving? So if accounts receivable is increasing and your revenue is not, you'll have a collections problem. How do you detect that? Your percentage of revenue is going to increase. So let's say revenue is flat next year. Next year, our accounts receivable jump from 2,500 to 5,000. So next year we had 5,000 in accounts receivable, yet 10,000 in revenue. What does that mean? That means the percentage of revenue left outstanding is not 25%, it's gone up to 50%. Doubled. So you got a problem, right? Because that multiply that by 360, that gives you 180 days. So now you can better determine if an increase in revenue is a problem or not by comparing it, an increase in accounts receivable is a problem or not by comparing it to the revenue. If, however, accounts receivable increased, but your revenue increased as well, you can use the measure of days to determine that it's a healthy thing. If accounts receivable is 5,000, for example, but your revenue doubled to 20,000, right, then that's still 25% of revenue. You multiply that, it's still 90 days. So here, by looking at the days, we can determine if an increase in accounts receivable is a positive sign or a negative sign. If there's an increase in accounts receivable and your days are increasing, that's a problem. That means your accounts receivable is increasing, but your bottom line is not. If your accounts receivable is increasing, but the days is held flat, that's a healthy sign. That means your accounts receivable is increasing and your business is growing accordingly. So for that reason, when looking at working capital, we need to, first of all, identify which line items are actual working capital line items. And then we want to think about what are the operation line items that we want to compare each of these working capital line items to. We want to analyze what that means as days, and we're going to use days to make our projections. Any questions on that? So let's do that. So let's open up the model. And if we look at operating working capital, we first want to identify what are the appropriate operating working capital line items. And so we kind of did this, and I'll just go over it briefly again. We looked to the annual report. So if we pull up the Walmart annual report, we had, going to open right to it. We first went to the current assets section of the balance sheet, always at the top. And it says right there, current assets. So we want operating working capital. So we want everything excluding cash. So if we get the top line cash, we have receivables, which is AR, standard, makes sense. Inventory, prepaid expenses. Those are common current asset working capital line items. Then this last item I'm going to exclude, discontinued operations. This is a one-time, non-recurring, anything extraordinary, non-recurring, I'm assuming is not constant modeled with everyday operations. It's one time, it's extraordinary, it's exclusive. So I would eliminate that. So we're gonna focus on 3 current asset line items: receivables, inventory, prepaid expenses. On the liability side, debts we exclude, top short-term debt, current liabilities. We have accounts payable, We have accrued liabilities. Accrued liabilities is accrued expenses, same thing. We have accrued income taxes. Long-term debt due within 1 year, eliminated, right? That's debts. We don't want to do debts. Capital leases due within 1 year, debts. We're going to wipe that out. Discontinued operations, again, extraordinary. We're going to exclude that. So the only lines we're going to include is accounts payable, accrued liabilities, and accrued income taxes. So we have 3 current assets, and we have 3 current liabilities. So what I first want to do is hard code in what those line items are historically, pull them in to the working capital schedule, and then back calculate into what the implied number of days were. We're going to use those days to make our projections. So let's just model in these numbers. So starting with accounts receivables, we had, and I'm going to do both years, 5, 9, and I'm also going to do this, even though we could have done this directly in our working capital schedule. Since I'm thinking ahead, since I know we're going to need a hard-coded balance sheet, and I do not like hard-coding the same number in 2 places, I'm going to hard-code it into the balance sheet and then pull it into the working capital. You could have actually done the reverse. You could have hard-coded it into the working capital and then pulled it into the balance sheet, but I like to have the hard codes all in one place in the balance sheet. It's just preference. So I'm going to hard-code the line items that I want to see. So I'm going to start with receivables. I'm going to hard-code 2012. I wish I could do, hey, Brian, I wonder, can you do like Adobe PDF on one side and Excel on the other side? Is that possible? You're an IT guy. Display setting? Maybe at the break I'll because that would be so helpful. Extended desktop, isn't that here to the screen? You can do like to 3 screens.
Is it treating it like 3 screens, or is it treating it like your computer is one and that's one? It depends.
It's treating it like this is one and that's one.
It depends on how the projector is treated.
Right now, this display is just this both screens is one, right? So
Yeah.
find out if you can split the screen.
Yeah, yeah.
You can do it.
Okay. I don't want to get lost in the content, but I'm going to try it on the break. Because that would be helpful in a situation like this when you do hard coding. Okay. So sorry for that. So thank you. So 5937 is 2012. 2011 is 5089. Okay, 5937, 5089. And then we got inventory 4714. And you got 36437. And prepaid expenses is 1685 and 2960. So these are the 3. So again, it's 5937 for 2002 plus 2002 AR, 5937, 5089 for 2011 AR, 4714 for 2012 inventory, 36437 for 2011 inventory, 1685 for 2012 prepaid expenses, and 2960 for 2011 prepaid expenses. Let's just do current assets first. Okay, so now let's pull in. As long as you have AR for now, let's pull AR in to the working capital schedule. We'll just link it in. So we're going to go to the operating working capital. So what you would have to do, I mean, this is a template. You would have to, if you're working with a template or building from scratch, you'll have to adjust your line items so the names match the line items that you've identified in the balance sheet. So we've identified 6, 3 assets, 3 liabilities. We'd have to adjust the names so they match. And so we had done that. So AR, we're going to pull in 2011 AR from the balance sheet and 2012. Just 11 and 12. You could have gone back 3 years if you wanted to, but notice that annual reports only report balance sheets usually for 2 years. If you want to go back a third year, you have to go to a prior year's annual report. Which brings up a side problem that a lot of you guys might face that might be helpful. A lot of times, always use the most recent data. So a lot of times, like this is a 2013 annual report. So if I pull up the 2013 annual report, I'll see 2011 and 2012 numbers. And then for some reason, for a good reason, if you pull up a 2011 report, that would have 2011 and 2010. You might see those 2011 numbers are different than the 2011 numbers that you saw in the 2012 report. Follow what I'm saying? That usually happens because accounting rules change. Maybe there's things like deferred taxes. Something happened where the company has to go back and restate its historical financials. So some people think it's more accurate to pull the numbers from that actual date of release. No, it's more accurate to use the most recent reports because those numbers might have changed based on the restatements. So always use the most recent reports. So if 2012 has 10, 11, 12 numbers, right? Use those 10, 11, 12 numbers because you might pull up the 2011 report and those numbers will be different, and the 2010 report and those numbers will be different. Yes.
So if there's a change in accounting principle or accounting method, wouldn't that be retroactive to going back to whenever?
Yes.
So would that not be reflected? Right?
It will be reflected in 2010 in the 2012 report. But if you pulled up the 2010 report at the time of filing 2010, before that happened, those changes won't be in there. And that's my point. So yeah. Okay. Now remember the formula is accounts receivable divided by some operating item, it's the percentage of revenue, times 360. That's the formula. But we're going to do something a little different. It's convention to take the average. I know I didn't do it on the board, I was thinking fine. It's convention to take the average AR. It's the average balance sheet line item. The average from last year and this year. And the reason why is because, okay, fine, so we have 5937 receivables in 2012, but it doesn't tell me that we've generated 5937. The balance sheet is a specific point in time. I could have had 5937 last year, meaning nothing's changed. Right? I could have had 0 last year, means I actually generated 5937. I could have had 10 billion last year, which means 10 billion down to 5937 is a big change. So so you never actually know what's gone on from last year to this year. I mean, yes, they're giving the final numbers, but you don't know the interim, like what's bounced from month to month. So just to smooth that over a little bit, we take the average of last year's and this year's most of the time. Just in modeling, the actual formula for calculating days is the average last year and this year's balance sheet line item divided by the income statement line item times 360. That's the formula. So we're going to take equals average. I'm just going to type in average, open parentheses. This year, comma last year. Divided by income statement. What do we say? Revenue. We don't do the average revenue because this is actually what's produced in a specific year. Only balance sheet times 360. So that is the formula you want to kind of memorize. Average this year, last year, divided by revenue times 360. Yeah. Average this year, last year, divided by income statement line item times 360. Enter. What does that give us? 4.4 days. Very, very low. Does that make sense? Why? You want to know. Why the nature of the business? Explain that. Yes, you're right. Why?
Because you take your goods up Walmart.
Yeah. Yeah. This is straight up retail, right? Customers are not paying on credit. And when I say pay on credit, it doesn't mean you're paying with a credit card. Paying with a credit card is not booked as accounts receivable because the banks assume that liability, right? If even a customer pays with a credit card, Walmart's getting basically the funds right up front, right? So in a business like Walmart, there should be very low receivables because customers are paying it. This is a cash business. So it makes sense to have a very small number of days. Okay, let's try it now for inventory. Let's just practice the historical formula. Inventories, I want to pull in inventories from the balance sheet. Again, pulling in the inventories. And I want to use the similar formula. So what formula do we use for inventory? Yes, Sam.
You essentially do the same thing, but instead of using revenue, you use cost of goods sold.
Yeah, absolutely. Yep. It's effectively the same thing. So it's the average of this year and last year divided by not revenue, because inventory is not related to revenue. We relate inventory to cost of goods sold. So it's divided by cost of goods sold times 360. So it's going to be equal to the average this year and last year divided by income statement cost of goods sold times 360. Any questions? You guys keeping up? You want to see the formula again? Doing all right? Let me know. Prepaid expenses. Let's pull in prepaid expenses. What do we relate prepaid expenses to? Formula, same template. This year, average this year, last year, divided by income statement item, whatever it is, times 360. That's the same formula for everything. It's all these historical accounts. But what's the income statement line item here? Most likely. Why are you saying that?
Well, it's your prepaid expenses, so you kind of have that linked to your sales dinner and admin stuff.
You got to know, yeah, you got to know what expense they're prepaying. And we're lucky here, and they just lumped everything together in SG&A. Sometimes you don't know, and sometimes you either have to kind of do some researching on it, or you're not going to prepay COGS. Well, you could, but they already had a line item related to COGS. You're not going to prepay revenue. It doesn't make sense. It's an expense. This is the only other expense we can relate it to. So they kind of made it easy for us. It's got to be though some sort of SG&A expense. And we'll see examples where, and you might have models where you have 5 or 6 operating expenses. If you had 5 or 6 operating expenses, like in other words, they broke down SG&A into 5 or 6 different categories, how do you know exactly what line item that prepaid expense is related to? You might not. You can do a word search. If you're lucky, they'll maybe talk about it in a note. If not, by default, you can just take total operating expenses. You can compare just to total operating expenses as a default. I think that's a good way. So we'll see this in some later cases where it might be not so straightforward. Remember, don't get too good. We're just looking for trends. So it doesn't have to be the exact match. But as long as you relate it to one of these expenses, knowing that we've modeled out expenses in relation to revenue, that means that our current asset line item is going to be projected in relation to revenue effectively.
Question,
Yes.
I had a situation where I had a hard time finding something that, in the case that, let's say, they had a line item for provisions, do you assume that maybe in an SG&A framework? You didn't say anything about it, it said the line item for provisions, that's it.
It just said provisions.
Yeah. You assume that would be like a prepaid expense or something?
I might not consider that a prepaid expense. I mean, provisions, what type of company was it? Did you ask me this?
No, this is agriculture.
I can take a look at it. Provisions is something different. I can take a look at that. I want to be careful. I don't want to generalize that. Let me take a look at it, if I could, if I'm allowed to. Provisions might be receivable. Provisions might be payable. Oh, side accounting question. Anybody accountants? Accountant? There we go. What's the difference between accounts payable and accrued expenses?
Well, accounts payable is basically related to costs.
Why?
Because
It's cheating. You know this. Does anybody know? I led you on. I'm like, oh, and then I was like, no, you don't answer. Well, let's say, Danny, what do you think?
So generally, account payable, right? Account payable is more like a one-time thing. So such as like legal or like for other professional services, accrued expenses for employee wages. Say like if you pay the employee for monthly, but you report like weekly events.
But why is that? Why would you categorize recording a line item as accounts payable instead of accrued expenses? I guess is kind of what I'm getting at. Not that you're wrong, Sammy.
I'm not certain of this, but my best guess is that accounts payable is more related to suppliers and things like that.
Why?
Because it's more so it represents the inventory sort of process of it as opposed to the day-to-day operations of the business.
And why is that important? You're going to add to that, AJ.
Is it because one is you actually know what one is obviously when you're going for, and the other one is realized costs?
Well, SG&A may or may not always be realized, especially if there's a prepaid expense against that. What's Terry?
Sure.
What were you going to say? Yeah, we're still on the same question.
Oh, I wasn't going to say anything. I was lifting up this.
No, okay. What were you going to say before I cut you off?
Right. Basically, accounts payable relates to your core business, which is your so it deals with your suppliers, with inventory, etc.
So what Sammy said.
Right. Accrued expenses deals more with your OpEx and your selling general and administrative.
Why is there a difference there?
Because we don't include, if you want to work on your cash cycle, you need your accounts receivable, your inventory, and your accounts payable separate from those other prepaid expenses and
Why?
liabilities. Because you want to know how much of your business you need to finance your working capital, how many days you need, which will help you to see if you need to have short-term financing for those items.
So I read, and you'd be good to see if I'm overshooting with this, but that accounts payable, and there's a lot of gray area between accounts payable and accrued expenses, that accounts payable is reserved for items that you can collateralize, that are backed against an asset. So in other words, accounts payable, based on everything that you're saying, it's related to suppliers and inventory because manufacturers would allow you to borrow against that because you can collateralize it against the asset of inventory. Otherwise, you can't categorize it as accounts payable. You can't borrow money against salaries, so to speak. So that's what I heard, which I think is a nice tangible way to make that distinction. But I don't know, yeah, I guess it's the same. But now we're getting into this. I don't think anyone ever get asked this in banking. This is not a banking question. This is like an Ernst & Young question, I think. And I think it's very specific. But a lot of people record accounts payable and throw accrued expenses in there, and it's kind of there's a lot of gray area. I don't know if there's any. A lot of times you see line items called accounts payable and accrued expenses all in one line item. But I read and I thought it was an important distinction that traditionally accounts payable should be reserved for items that you can collateralize because accounts payable is almost like a reverse loan from a manufacturer. And they'd only lend against things that are like inventory that you can collateralize against. I don't know. I thought it was just interesting. Okay, how do we get lost on that? Oh, just determining where you would figure out the supporting underlying line item for prepaid expenses. And so let us base this on the total SG&A. So this is going to be average equals average. This year, last year, divided by income statement, the operating expenses, SG&A, times 360. 10.8 days. Yeah. Yes, Sam.
Just really quickly, as far as taking the average, do you always take the average of this year and last year, or do you sometimes take the last couple of years, depending on how much information you have?
I've always seen just this year and last year. If you want to incorporate the last couple of years, then you can have a day's metric in 2011 that incorporates the average of 2010 and 2011. I've never seen an average of like 5 years in the past.
It's unnecessary.
Yeah. I've seen them do this days per paid analysis 3 years in the back and then maybe average those days for your projections or things like that. That's the way I would incorporate historical years. Okay, let's total the current assets. So you can't do it all equals because you do not want the days number added to your total. It's just the sum of the 3 line items that we've had. Oops. And I'll copy it back 1 year. I'll copy it forward, even though it's going to be 0. So that when we make our projections, we can, just total our projections right up. So again, this is just a sum of the F7 plus F9 plus F11. And then we'll do the same thing for the liabilities. So we've identified 3 liability line items. We said to skip short-term debt. We have accounts payable, which is 36608, 2012, 36608. And these should be, I'm sorry, I was going to say these should be in the balance sheet. Accounts payable is 36608. And the year before is 33676. Yeah. And then accrued liabilities is 18701. And the year before is 18154. And finally, accrued income taxes, which is 1164. Oops, I flipped this. This is 18154 in 2012, 18701. So 2012 is 18154. Sorry, 2011 is 18701. Accrued income taxes is 1164 and 157. 1164 in 2012, 157 in 2011. Got it? And we will pull into the operating working capital, we'll pull in the accounts payable. And we'll calculate the same formula. The average of this year and last year divided by what? What do we relate accounts payable to? Cost of goods sold. So this is going to be the average of this year, last year, divided by income statement cost of goods sold times 260. 37.8.
Oh, you show the formula again?
Yep. This year, last year, divided by cost of goods sold times 260. Same template all the way through. Accrued liabilities. We're going to pull from the balance sheet accrued liabilities. Now, what do we relate accrued liabilities to? Most likely SG&A, just like prepaid expenses. Accrued liabilities is quite vague in terms of what is the actual expense that they're deferring. This is an expense that they've booked, but they haven't paid it yet. I mean, AR is always related to revenue. Inventory always related to COGS. Accounts payable always related to COGS. These other line items you kind of have to think about, do a little bit of research. Again, it was made easy for us because there's only one other expense line item for Walmart, so naturally it has to be that line item. But if you have a situation where there's several line items, you're going to have to kind of think about it. When in doubt, just use the total operating expenses. That's the way I would do it. So I'm going to take a look at, I'm going to do equals average this year, comma last year, divided by income statement, SG&A, times 260, 86. We also have accrued taxes. Let's pull in accrued taxes. Statement. Thanks. This year and last year. And what do we relate this to? This is a slightly unusual one. Remember, this is different than deferred taxes. How is this different than deferred taxes? Remember what we discussed? How is accrued taxes different than deferred taxes?
Deferred means you don't pay this year, accrued would be the ones you had to pay when I had to pay them.
Yeah, so at least in Walmart's case, deferred taxes is more than likely based on accounting differences between GAAP and tax, right? Whereas accrued taxes here, as they define it here, is literally the taxes that have been incurred that you have to pay by the end of the year. It is based on the taxes that have been expensed. And so for that reason, I would look at this as a percentage of taxes. You can also do it on EBT, earnings before taxes. Kind of a toss-up as long as it's, either way, it's growing in the same percentage. So again, my point is you kind of have to infer what is this line item doing to understand what it's a portion of. Right? Accounts receivable is a portion of revenue. Right? Cost of goods sold is a portion of, sorry, inventory is a portion of cost of goods sold. Accrued taxes is a portion of the taxes that are incurred. So let's take a look at this as an average. And this is going to be pretty skewed because it looks like they didn't do it last year. It was very small last year, but let's just go with it. Divided by income statement. The tax number has been projected. Income tax expense times 260. 29. I thought the number looked crazier than that. Okay, let's sum that up. You can copy this to the left and the right. I'm going to save this. Okay. And so the total historical operating working capital is the assets minus the liabilities. So it's negative. So it's negative. Is that a problem? Walmart certainly is in a bankrupt business. Their liabilities are greater than their assets.
That is currently, that's what's going on.
Could be currently that's what's going on. Just all you guys get this historicals in there. Let's take a break and then we'll talk about it. A little early, but otherwise we'll get lost in the next pieces of it. This is an ideal time for a break. So we're discussing a little bit about the idea that this working capital is negative and what your thoughts were on that. Any thoughts? Is that good? Is that bad? What does it mean? What does it mean it's negative? Sam?
Typically, when your liabilities are greater than your assets, it means you're insolvent. But in this particular case, this is just the operating capital, so
Right.
it doesn't include the cash.
Right.
Which makes a pretty big difference in terms of whether or not they could
Yeah.
have their liabilities.
Yeah, I mean, well, on a total cash flow statement, they're kind of breaking even, I guess. You know, remember, the point is to manage this effectively, and they're not necessarily insolvent because their liabilities are greater than their assets, right? Because their liabilities, and from a current working capital perspective, because the liabilities are not necessarily due today. They could always replenish that with more liabilities. But it all depends on how you're managing it. And really what people look for is not necessarily the level of liabilities versus assets or vice versa. It's more, what's the year-over-year change, right? If you're managing working capital effectively, you hopefully want to establish a stability where that there's no major year-to-year working capital swings. So we're going to look at, it's not necessarily about, are the assets $5 billion this year, right? Is that good or bad? But it's really about what were they, what was the level of the assets last year versus this year? So for example, accounts receivable is increasing by $900 million. What is that? What impact does that have on your cash? Negative. Why does that have a negative impact on cash? Yeah.
Because if your accounts receivable goes up, that means you're collecting less cash from your customers.
Right. Right. I think it's more intuitive to think about accounts receivable is going down. If accounts receivable is going down, reducing, that means cash is coming in. You're collecting. You're collecting on the accounts receivable, and so the accounts receivable is going away. The opposite happens if accounts receivable goes up. As accounts receivable goes up, then cash is effectively negative. And that's true for every single asset, right? Think about buying inventory. If you're spending money to buy inventory, cash is down, but the inventory goes up. You're building inventory. You're buying inventory. If you're receiving money, you're selling your inventory. So this is true for every single asset except cash. If the assets are going up, that means cash is going out. If the assets are going down, that means cash is going up. So my point is, we're really more concerned about not the level of receivables, but the year-to-year change to see what impact that has on cash. The opposite is true for liabilities. If accounts payable is going up, what does that mean for cash? Is cash coming in or is cash going out? Say again?
Staying in.
Coming in, staying in. Yeah. So if accounts payable is going up, cash is coming in. So it's the opposite effect, right? An asset, if the asset's going up, cash is going out. Think about buying an asset. With the liability, think about a loan, right? If you're borrowing money, you get money, but you also get a liability. If the liability is up, the cash is up. So if an accounts payable is going up, cash is coming in. If an accrued liability is going down, cash is going out. So for all liabilities, it's the opposite effect in that If the liability is up, cash is coming in, or if the liability is down, cash is going out. So you want to look at the year-to-year change. So operating working capital, if you subtract this year from last year, has got up by 458. The operating working capital has increased by $458 million. It's become less negative. Does that mean cash is coming in or cash is going out? Think of working capital is assets less liabilities. It's a net asset. It's going out. It acts like an asset. It's a net asset. It's your assets less your liabilities. So if working capital, if your total working capital is going up, that means cash is going out. If the total working capital is going down, that means cash is coming in. So really, there's a lot of ways to analyze working capital from a cash flow perspective, which is what Sammy was suggesting. You really want to look at the year-to-year change. And this is how we're going to interpret the working capital into our cash flow statement. If you remember, what we projected, if you remember, we left out this whole working capital section. What they're asking for is, what impact does working capital have on the cash flow statement? We have to look at the change. If accounts receivable is going up, it's going to be negative on the cash flow statement. So this is where working capital translates into the cash flow statement. So to understand the impact of working capital on cash, it's not about looking at 1 year's assets minus liabilities. It's looking at the year-over-year change. That's working capital. That's why I always say changes in working capital. Changes in working capital. It's the year-over-year change that's going to impact cash. So we'll look at that. So before doing that, let's project working capital. And so what I'm going to do is I'm going to use the projected days, or the expected days, to make projections. We're going to use we're going to assume that accounts receivable is going to be based on 4.4 days. So we're going to hard code it at 4.4. And I'm going to use 4.4 to back into the implied accounts receivable. How do I do that? I'm just going to reverse engineer the formula that we used to make historical projections, which was AR divided by revenue times 360 equals days. So in making projections, we don't want to solve for days. We have days. We want to solve for AR. So if we divide by 360, divide both sides of the equation by 360, I would eliminate this. And then we would have AR divided by revenue equals days divided by 360. Basically, if you want to think about this, we're saying, all right, well, we have 4.4 days. Let's use the standard example of 90 days. We had 90 days. I want to convert those 90 days back into the percentage. 90 days over 360 is 25%. So basically 25% of my revenue is going to be my future accounts receivable. So I'm going to take that 25% and multiply it by my future revenue, and that's going to be my projected accounts receivable. So basically what I'm doing is I'm just figuring out whatever days I use as my projections, let me get that percentage, days divided by 360, and then I'm going to multiply it by the revenue. So there's two ways to think about it. You can either think about it doing the algebra, or you can think about it just kind of logically. So if I multiply revenue by both sides, this cancels, and I'm left with AR equals days divided by 360 times revenue, and that should make sense, right? This gives us the percentage multiplied by the future revenue. That's what we'll do. So that's the formula for making a projection. So you can either memorize it, or you can just know how to convert it, or you can think about it logically. The days divided by 360 gives you a percentage times the revenue center.
I just had a question in terms of, I guess, modeling etiquette. In situations like this, where you're going to take the last year and use that same days receivable, is it best to hard code the first one and the rest of
I've seen it done all different ways. To be honest, I know it's not. It's probably. It depends on why you're doing 4.4. If you're doing 4.4 because you're just taking the exact same information as the year before, it probably makes the most sense to have it to be equal to 4.4. It will have a very, very, very minor difference in the numbers, but this in the book I hard coded it just because it was easier to write that way, and it doesn't make much material difference, but probably it's more on the implication. So if the idea is you're taking 4.4 because you want to take exactly last year's metric, then it's probably a little bit more accurate to do equals to 2012 and copy into the right. Good question. So let's use the reverse engineered formula, which is going to be equal to the 4.4 divided by 360 times 2013 revenue. Real simple. So we're going to go into 2013 revenue, and we're going to copy everything to the right. That is our projected accounts receivable. And we're going to use this method all the way through. You guys got that? Next year, 41.4. I'm going to hard code 41.4 days. I'm going to reverse engineer the format. 41.4 divided by 360 times the related income statement line item. And for inventories, we used cost of goods sold. It's going to be equal to 41.4 divided by 360 times 2013 cost of goods sold. You guys got that? We're going to do that all the way through. Days prepaid, 10.8. So the formula is going to be 10.8 divided by 360 times whatever line item we use to relate prepaid expenses to. What line item do we use? SG&A. So it's going to be 10.8 divided by 360 times the SG&A. Projected SG&A. Copy that to the right. And you can continue. $37.8. Now we'll go to the liabilities. Same idea. 37.8 divided by 360 times what? Related accounts payable to? Cost of goods sold. 37.8 divided by 360 times top to the right. Any questions? $86 for accrued liabilities. Accrued liabilities is related to SG&A. Accrued liabilities, sorry, 86 divided by 360 times SG&A.
Just wondering if it's Is it better to have the 360 itself? So if you want to change this, it might need.
You could. Yeah, that's a good point. Yeah, you could have 360 overlay, and then more just so someone sees exactly the data that you're using. So if they change, but usually that's not something that's that's variable. That's so often. Oh, let's make it 360. Let's make it 365. You usually come up with you have your own method, and that's usually quite fixed. That's why I didn't do it, but you certainly can. Absolutely. And then accrued taxes is the 29 divided by 360 times we used taxes. So we're going to use future taxes. Way down here. Tax expense. Copy that to the right. Okay, we can copy over the working capital. And this is what we should expect to see. No major fluctuations. The trend is in line with what we had historically. We're just building this off of the way revenue is growing, effectively. And the changes. So this is going up. If our working capital is going up, increasing, that means cash is going out. This is going down. This is going down. If it's going down, it means cash is coming in. So let's talk about how to relate this to the cash flow statement, and then I'll explain to you what this match is doing. There was a couple of matches in a financial model. It's supposed to be sanity checks to avoid the possibility of making common errors that analysts make. So matches help you as an analyst make sure that we're avoiding some of these common problems. You guys have this? Once you have this, really the purpose of the working capital schedule is number one, to analyze working capital on a standalone basis, but it also serves as a bridge from the balance sheet to the cash flow statement. So we want to interpret these cash flows from the working capital into the cash flow statement. So for example, we had mentioned if we see AR going up, that would represent a cash flow statement, a cash outflow. If we see AR going down, that would represent a cash inflow. Here it's going down, so we should see cash coming in on the cash flow statement. So if we go to the cash flow statement and accounts receivable, if our accounts receivables are going down, we should see cash coming in, right? So we want to pull that difference into the cash flow statement. 2013 minus 2012 will give us a negative number. I want to show this as a positive number because if AR is going down, cash should be coming in. So I want to show this as, I want to pull this in as not the change, because the change from 2013 to 2012 would show a negative. I want to show it to be minus the change. It's minus the difference, or you can subtract backwards. Minus 2013 minus 2012, right? It's minus the change because of the relationship between the assets and cash is the opposite. If the assets are going down, cash is going up. If assets going up, cash is going down. So it's minus the change. Always for every working capital asset. Okay. Minus change. Minus in parentheses operating working capital G7 minus operating working capital F7, those parentheses, minus the change. Okay? True for every single current asset in the working capital section. So inventory minus the change. Because of the relationship between cash and inventory. Cash down, inventory up. So this is going to be minus operating working capital, 2013 minus 2012 inventory. Up to the right. You guys got that? Okay. Notice that the next line item that the cash statement has is accounts payable. We have prepaid expenses. We got prepaid expenses here. Actually, if you think about it, we have 1, 2, 3, 4, 5, 6 working capital line items, but in the cash statement, they only have 4. That's a problem. That's a common problem you guys will likely face. Why is there a difference? Why have we identified 6 working capital line items for our operating working capital section, but there's only 4 in the cash flow statement? Anybody know? Anybody know why the difference? Nobody knows? I don't think anybody actually really knows. No.
It's not because it's categorized in another line item outside of it.
It could be, yes, but generally, so if you notice, one kind of misnomer in modeling is this section, changes in certain assets and liabilities, net of effects of acquisitions, is not actually changes in operating working capital. But we want it to be in modeling. So we've identified as analysts this section in cash flow from operating activities. We've identified cash flow from operating activities to be net income plus depreciation plus deferred taxes plus changes in operating working capital. We do that as analysts, as bankers, because that's how you get to DCF, right? And it looks like that on the actual cash flow statement. They have net income plus, here are all the adjustments, or this is just headers, plus depreciation, deferred taxes, other operating activities, and then this section, which is almost operating working capital. There's a tiny different stuff, and it confuses a lot of people. This is changes in certain assets and liabilities, net of effects of acquisitions, which means 2 things. First of all, ours is a net of effects of acquisitions, our numbers. You don't know how to strip that out. And when I say ours, what's the difference between ours and theirs? We've identified ours based on the balance sheet, not based on the cash flow. I would always go by the balance sheet. There's a difference between their balance sheet and cash flow line items for 2 reasons. One, the cash flow statement contains some other adjustments, either non-recurring adjustments based on acquisitions or non-cash adjustments that you won't be able to identify in the balance sheet. That's one thing. That's one reason why it's different. And 2, nobody said this is operating working capital. So what's the difference between operating working capital and just changes in assets and liabilities? Cash and debts. And also, more importantly, working capital is current assets. This is not necessarily current. This might contain long-term stuff. This might contain long-term receivables, uncollectible receivables. This might contain long-term payables, and sometimes it does. Sometimes you will see a changes in certain assets and liabilities section in your companies, in your models, that might have a line item called changes in other non-current assets in that section. Non-current. We want current stuff. So this is a problem. This is a problem that you always have to identify in modeling. How do you come on? First thing is you'll never be able to tie it together. Even if you take, and let's give the example right here, even if you take accounts receivable, which looks so obviously simple, and if you go to the accounts receivables from 2011 to 2012 in the balance sheet, let's do that right now. In the balance sheet, you'll have 2011, 2012, where's our balance sheet? Accounts receivables will have, receivables is 5089 to 5937. It's about 800 and something, 5937, 508. Actually have it right here. 5089 to 5937 gives me 848. So I should expect to see negative 848 in the cash flow statement for 2012. What do I see though in the cash statement for 2012? I see 796. It's a little bit different. Yes.
Is that because the balance sheet is it's a cumulative sum and that this is specifically for this?
No, because the change should quantify that.
Right.
There are other adjustments in the cash flow statement that maybe they're adjusting for what's been determined as uncollectible accounts receivables. There might be adjusting out as net of effects of acquisition. Maybe some of the AR has been written down or sold that didn't really impact cash. There could be a host of different reasons why it's different. And so the question is, what do we do? So number one, from a historical basis, you're never going to match it up. Don't worry about it. Just make sure your projections match up, because really the important thing is we want our operating working capital as we define it, because that's important for our DCF. That's really for valuation. So you will see situations where you've identified working capital as per the balance sheet, and it doesn't match the line items they've identified in the cash flow statement. Whereas, so for this example, we have 6 balance sheet line items, and there's only 4 in the cash flow statement. So the question is, how do you mitigate that? And there's 2 things you can do. You can either remove line items or add line items, and you got to make the decision. So in this case, and I would just kind of guesstimate it. So in this case, we had AR, we had inventory, we had prepaid expenses as the assets. Liabilities, we had AP, accrued liabilities, and we had accrued taxes. That's the balance sheet. The cash flow statement had AR, inventory, accounts payable, and accrued liabilities, right? So you want to do your best to match them up, right? AR is obviously AR, inventory is obviously inventory, AP, this is pretty self-explanatory. And so what I would recommend doing is just creating in the cash flow statement 2 new line items that'll satisfy our projections only. One for prepaid expenses, one for accrued taxes.
So adding those line items to the cash flow statement?
Yeah, increasing them. Creating an extra line item just for our projections. I'll show you how to do that. Another thing it could have done is assume, well, you know, accrued taxes, maybe they bump that in with accrued liabilities in the cash flow statement. And then in the balance sheet, you would have added these line items together and combined. The way you're making projections, it's not going to make any difference in the future numbers, whether you separate them or combine them. So just guesstimate. Just make sure you're accounting for both. Now, the way I do it is, you can just tell by reading the line items if it's self-explanatory or not. So a lot of times we'll see in the next model, in the Highs model, for example, they would have, I'll give you an example, they would have a line item that said, you know, on the balance sheet they had, let's say, accrued liabilities and accrued taxes. But in the cash flow statement, they said changes in accrued liabilities and taxes, right? So in other words, it's self-explanatory a lot of times. So if they see that, then you can, I was like, okay, well, they combined it in the cash flow statement. So what would you do to keep things simple, to keep things flowing? I would literally just add these line items together and make it one line, so you can link it directly. So you need to make the decision whether you should combine the balance sheet line items to make 4, so it matches the cash flow, or do you add cash flow line items to make it 6 to match the balance sheet? You just gotta come on, you gotta make that educated guess. And there's really no right or wrong, just be consistent. You need to have the same number of line items, otherwise things will not flow.
In that scenario there, so you think the best bet would have to try to, I think I was doing one last week, I was trying to have my balance sheet see if I can match my current cash flow with the future cash flow, project my cash flow from the balance sheet minus the line items and then find out the difference between there.
Yeah, you're gonna drive yourself nuts doing it. Yeah, did you ever get to an answer?
No.
I've rarely seen anyone ever, I've never seen anyone really do that, successfully. And it doesn't, when you start to get familiar with the flow and how things are projected, it's not gonna help you in your projections, really, because you really just care, all you really care about, regardless of the nuances in between, is the total changes in working capital, is the total. So however you spread these around, as long as you get the same total, you'll be fine. And so, you know, a lot of times you have 3 or 4 different accrued liability line items. They're all being projected off of total OPEX anyway. So whether you keep them separate or combine them, you're going to get the same numbers. Or whether you reallocate them, you're going to get the same numbers, or at least similar numbers. So it's just not worth the time.
So it's more like when you project these, make sure at least those line items are there.
Yeah, you just got to make sure. So this is so hopefully to solve a lot of problems with these differences. Number one, look to the balance sheet to identify what the true operating working capital should be. Use the balance sheet. Don't use the cash. The balance sheet is the core measure. And then you have to, when comparing the cash statement, make the decision to either, if they don't compare, sometimes they'll compare. The numbers will never match, but sometimes the line item names will match, or you'll get the same number of lines. If you don't, you have to say, well, do I either add line items, and we'll do that with Walmart, or do I combine? And when if I combine, I would just literally take, let's say if I had decided to combine, I would literally say, all right, well, let me just, where are we in liabilities? Let me just, if I had decided, let me combine these 2 line items, I would have literally just eliminated this, called this accrued liabilities and accrued income taxes, and added in this cell the 18154 plus 1164. I would literally just combine it and be done with it. So that it's now 4 balance sheet line items and 4 cash statement line items. That's one way to do it. I chose to be more explicit, and I said, let's keep the balance sheet line items as 6, and I will add 2 cash statement line items in the future. So I'll show you how to do that. So right now we're faced with a situation where we have this prepaid expense and other line item. It doesn't exist in the cash flow statement. So I'm going to just add a line item. So in accounts payable, shift spacebar, right? Control shift plus. And I'm going to call it, I'm going to make up the name changes in prepaid expenses. And I would just make it 0 historically, so the historicals will still match and flow. And then in the future, like every single working capital asset, it's minus the change. It's minus, open parentheses, this year minus last year. That way we will have a balancing model. So if you had chosen to combine, you're basically going to get in one line item 922.3. You're going to get the sum of this. It's all going to come out to be the same thing. Just we're going to make sure that you've matched them. It's just something that I've seen analysts struggle with endlessly, and hopefully this is helpful. Got it? Now we can move on to liabilities. Guys, need a minute? Okay. Changes in accounts payable with liabilities. It's a little bit different in that, obviously, if it's an increase in the payable, cash is coming in. If it's a decrease in the payable, cash is going out. So it's not minus the change, it's just the change, right? Where this is going up, I want to see a positive number in the cash flow statement because cash is coming in, because the nature, the relationship between liability and cash is the direct relationship. So for accounts payable, I'm going to pull in the operating working capital, 2013 minus 2012, direct change. Real simple, straightforward. True for every liability. It's the direct change. Yep, accrued liability, same thing. 2013 minus 2012 equals 2013 minus 2012. Right?
We're not going negative at the beginning of that because of liability.
Right. We're not doing negative because of the relationship between the liability and cash is a direct relationship. It's not the opposite. We also have our sixth line item that again does not appear in this line item, accrued taxes. Accrued taxes. So we need to add a row in the cash flow statement for changes in accrued taxes. So I'm going to do Shift spacebar, Control Shift plus, changes in accrued taxes, which I'm going to hard code at 0, 0, 0. So it doesn't impact the historical, so the historical still match. And then for the projections, I'm going to again be equal to 2013 minus 2012. Copy to the right. And then you want to just be careful, make sure your totals still add up everything. For some reason, it's not adding up everything, so I want to redo my sum total so it adds up everything. Same thing for, just make sure the totals add up everything again. Then you should be getting these numbers. I'm going to take the highlights out of here because we now have that done. We got most of the cash flow statement done now. Any questions on that?
What line items up after the changes in recruiting expenses?
You mean here? No.
Yeah.
Changes in accrued taxes. I did that to match the accrued tax line in the working capital statement. Got that? You're getting those numbers? Take a second to match them up. You guys okay? Yeah? Okay. So now I got most of the cash flow statement done. The only thing left over, the only thing left to do is in the financing activities, short-term borrowings, long-term borrowings, capitalize the debts. The debts which are going to be dependent on the debt schedule. But before doing the debt schedule, I recommend the debt schedule to be the very, very last thing you do. Let's look at the balance sheet. And so remember what we discussed, just to kind of be more formal about this. Is the balance sheet. Is a summary. The balance sheet is a summary of a company's assets, liabilities, and equity on a given date, a point in time. So there's this formula that should always hold true with the balance sheet, meaning the assets minus the liabilities should equal the shareholders' equity. So we kind of did that when we did on the first day of the income statement, cash statement, balance sheet flows. Every time, it's a good sanity check to make sure that the sum of the assets minus the liabilities must match shareholders' equity. And this is a struggle in keeping your balance sheet in balance when you're projecting line items. When you're projecting the balance sheet, you need to project each individual asset. You need to project each individual liability. You need to project separately each individual shareholder's equity and do it in such a way that this formula still holds. The assets minus the liabilities should equal the shareholders' equity. Or other people sometimes look at it as assets should equal the sum of the liabilities and the shareholders' equity. Same thing, it's just algebra. And so we spoke about assets generally for working capital, but more formally, it is a resource that has some sort of economic value and is expected to provide future benefit. Assets are broken up into two categories: current assets and non-current assets. So we've spoken about current assets, cash, marketable securities, accounts receivable, inventory, prepaid expenses. That's basically utilizing operating working capital. And then long-term assets, core long-term assets are things like PP&E, property, plant, and equipment. Property, plant, and equipment is modeled and projected based on the capital spend on future property, CapEx, which you've already projected in the cash flow statement. And depreciation wears away at our PP&E. We've talked about depreciation and CapEx. We're going to show you how we model that out. And then goodwill. So we're really going to focus on goodwill and M&A. Goodwill is a result of when you pay for a company that's greater than the historical value of that business. A lot of that difference goes into goodwill. It's a topic of purchase price allocation. We'll talk about that. Goodwill is basically the premium above, accounting for the premium above the book value of an asset or an entity that you're acquiring. So that premium needs to be accounted for somewhere. That premium is goodwill. So that's an example of a long-term asset. Investments, other examples of long-term assets. Liabilities is a debt or obligation. And so we have current liabilities, we have long-term liabilities. We spoke about current liabilities. We just dealt with them in operating working capital. It's short-term debt, accounts payable, liabilities. Non-current liabilities are things like long-term debts, capital leases. Deferred taxes is typically long-term of any other outstanding loans. Long-term pension obligations, long-term liability. Any debt or obligation that's not going to come due within a year. It's a long-term liability. And shareholders' equity, I basically categorize as two major items: equity and retained earnings. And when I say equity, I mean common stock, preferred stock, stock that's raised, or stock that's bought back. Stock that's bought back is listed as treasury stock. It's stock is in your shareholders' equity. And retained earnings is basically the net income in the business that has not been paid out and distributed to shareholders or minority interest owners. It is your earnings that's been retained in the business. We spoke about how the net income from the cash flow statement links into retained earnings. So we're going to model this stuff. So first thing to note is obviously the structure of the balance sheet, where it's assets, current and non-current, liabilities, current and non-current, and then shareholders' equity. And what you want to do is you want to look to the balance sheet financials and first just hard code, just lay out all the balance sheet line items and gain a good understanding as to what the company's balance sheet looks like. And then we want to talk about techniques of how to make projections to these each and every individual balance sheet line item. So let's start by looking at the balance sheet. And before I do, there's one thing that I had forgotten to mention is this working capital match. So in operating working capital, we have a match, and if you notice, the match was N, and it should be Y now. This is a sanity check. This is to make sure that you are linking things from the working capital into the cash statement properly. One thing most people mistake is getting the signs wrong here, forgetting the minuses, or a lot of people just forget the minuses, just calculate the difference. You got to think about, is it plus the change or minus the change? And for assets, it's minus the change, right? We always put minus the change for every asset, and plus the change for every liability. Some people just forget that. And so this match helps kind of make sure that things are flowing properly. How it works is really it's checking to make sure that the change in total operating working capital is identical to the change in total operating working capital here. And it works because you're basically calculating changes in total operating working capital two different ways. This changes in operating working capital is adding each individual difference. It's taking each individual difference and adding it up. Some of the differences. Whereas in the operating working capital schedule here, we are taking the total working capital. We're not taking the individual differences. We're taking the total and we're subtracting the total. So if subtracting the total does not match adding the individual subtractions, then you're subtracting things in the cash flow statement the wrong way. This is a great way to prove, and if that's confusing to you, in the book I lay it out in more detail. This is a good way to prove that you are getting your signs correct. In other words, this is just subtracting the total, whereas this is taking a sum of each individual subtraction. So if I had messed up the signs here, this number would have been different, basically. This helps make sure you're not messing up the signs. If the match is no, there's something wrong. Probably have the signs. Okay, based on what we discussed about the higher level, what a balance sheet should look like, let's just lay out the balance sheet historically. And just like, remember when you're hard coding income, you're basically laying things out and you want to kind of identify line items, you have to think about it. You want to pull out non-recurring events, you want to make sure EBITDA comes through because EBITDA is not a GAAP requirement. When doing the cash flow statement, you basically want to just lay things out as is, line by line. Same thing with the balance sheet. You kind of want to more or less lay things out line by line. Good news is we've hard coded a lot of the stuff already. Let's just do that. Let's look at the balance sheet. And in the balance sheet we have, first of all, current assets cash, 6550 and 7395. Let's just hard code that in, 6550, 7395. So Walmart has, for current assets, cash, and then the three operating working capital items that we've already identified, receivables, inventory, prepaid expenses. They also have this kind of discontinued operation line item. Let's hard code that in. That's 89 and 131. And we can alt equals, we can total our current assets. And we want to just make sure the totals match. If the totals don't match, we probably put something in wrong. That's the current assets. So it basically has cash, the working capital line items, and this non-recurring event. So you should start to be familiar with what these line items are. Current assets. Pretty straightforward. Okay with that? Next, on Walmart's balance sheet, they got long-term assets. They got all this property. We've just decided, for purposes of keeping a simplified depreciation schedule, we consolidated the property. They separated the core property versus the property that's held under a capital lease. It's still PP&E, so for our purposes, we said just to combine them. We did 109,603 plus 2721. We already did that in 2012. Let's do it again in 2011. So that's 105,098. So this should be equal to 105,098 plus 2780. Consolidated. We did do some consolidation here to simplify. Up to if you want to keep that separate. But if you did, then you would have to have separate depreciations, and it's not necessary. Got it? Goodwill. We just talked about what goodwill basically was. We will work with goodwill extensively in the M&A portion. So they have, where's their goodwill? So down here they have goodwill, which is 2651 and 16763. And other assets and deferred charges. So this could be many different things. 5456, 4129, and I'm going to do all equal to sum up everything, including the current assets, to make sure that the total assets match what's been reported. 193,406, 180,782 matches. So we're doing okay. Yep. Question on that? You're getting that? Or just hard code? Down to liabilities. Got a couple things. First, we have short-term borrowings. Let's mark that in. we're doing everything as is, 4047. And the year before is 1031. We got a bunch of line items we already hard coded in because they're working capital, they're operating working capital line items. And we have a few other line items that we didn't hard code in because we did not include them in working capital. They're related to debts and the discontinued operations. We want to just hard code those in. So long-term debt due within 1 year, 1975, 4655. Obligations into capital leases, 326, 336. And then discontinued operations, 2647. No one's spent too much time hard coding. I can do this at home easily. It matches 62300, 58603. So we just hard coded in the short term, which is the 4047 and 1031. And then we hard coded the three debts, 1975, etc. And these should all, you should know what these all are. Debts, we talked about the current liabilities, short-term debts. We're going to use those in the debt schedule. We then have long-term liabilities, which Walmart kept pretty simple. They have long-term debts and long-term capital leases. The long-term debt is 44070 for 2012 and 40692 for 2011. And the capital lease is 3009 for 2012 and 3150 for 2011. They have deferred taxes. We've spoken about deferred taxes. 7862, 2012, and 6682, 2011. And we talked about non-controlling interest, 404 and 408. So make sure you hard code those in and you add everything up, and including the current liabilities. Yeah, you guys have that? Whoops. Questions on that? And then shareholders' equity. So again, just kind of laying out things, the line items that they've laid out. One thing here, so first of all, preferred stock, they don't have any. So I'm not even going to include that line item. Maybe they used to have it. That's why the line has been lingering. Here, though, they have this common stock, 342, and then capital in excess of par value. What's capital in excess of par value? What do you guys know that to be? Do you know what capital in excess of par value is?
Is it additional paid in capital?
It's the same thing as additional paid in capital. What's additional paid in capital?
It's capital on top of the, excluding the par value.
Why is par value? What's the point of a par value? Anybody know what the point of it is? Why are you guys looking? You guys talked about it?
I think you need to go through research that.
Oh. Okay.
Okay.
Oh, he diverted. Yes. Why? Everyone know why? I actually did research it. It's an archaic accounting rule that's just been lingering. There's really no fundamental reason anymore. But originally, so when you want to raise equity, you first have to file what's called a shelf. The shelf, which is an allowance to raise shares. So when you file for the shelf, you're basically registering yourself. You have to do a lot of things to be registered to issue shares. You need to have 3 years of accounting from a Big Four accounting firm. You need to go through this whole regulatory process, approval process, and that's that whole process is filing for a shelf, which is an allowance to raise a certain amount of shares. In this filing process, you are required to put down some sort of nominal value for what you think the shares are worth. It could be anything, a penny, a dollar. This is just part of the shelf filing process. The current theory is there's just really no reason for that anymore, but it's still done. And so what happens is, so when you file this shelf, you file an allowance to raise an arbitrary amount of shares. You do something like 1 billion, some arbitrary number. It doesn't really matter, but it just allows you to raise up to 1 billion shares, and then you don't have to go through this process unless you've raised like 1 billion shares. But that doesn't mean you're actually going to raise 1 billion shares. It's just you have an allowance to do that. And so when you go out and actually raise shares, you don't have to raise 1 billion shares. You can raise 10, you can raise 20. When you go out and raise the shares, you have to separate the par value versus the value that it's actually been sold at in the market. So let's say you've established a par value in this shelf process of $1. You made up some sort of nominal value, $1, right? And you're going to raise 1 million shares. Now you go out and you say, I'm going to raise 1 million shares. So the way you record this is, and let's say I raise the shares I raise it out in the market at $10 per share, right? So the way you record in accounting is you record shares, and you put par value at $1, just like they have it here. So the number of shares, this is the 11,000 shares authorized, that's the shelf, at, what did it say? 10-cent par value. It was here at $1 par value. That's $1 million. And then I do my, you can abbreviate it as APIC, the capital in excess of par value, or APIC is additional paid in capital, means the same thing. That's the additional excess. So I raised $10 million, 1 million is the par value, so 9 million is the excess. It's the excess beyond the par value. So really the total is 10 million. Based on my research, a lot of people think it's just ridiculous. In modeling, we combine this. It makes no sense to separate. Any par value plus the capital in excess of par, we combine. Because when we're modeling out debt raise scenarios, we don't have to separate the two pieces. It's just ridiculous. We just combine. When you raise $10 million, we just increase that line by $10 million. It's important to know what this is about. So for that reason, we will combine, yes. No. Can this be negative? I've never seen it negative. I'm trying to think of in a distressed situation. I've never seen it negative. Has anyone seen it negative? I don't think it can ever be negative. Because even in a distressed situation, you wouldn't have negative value. It would be zeroed out. I mean, I guess anything's possible, but I've never seen it negative. I don't think it can be negative. You could have negative shareholders' equity, but that actual line item. Okay, we'll finish this tomorrow. I didn't realize it was 11 o'clock. Finish it tomorrow, then balancing the balance sheet, big important step. So we'll get to that tomorrow. Good, we're on track. Maybe we'll have time to start the debt schedule, maybe not. By Wednesday, we would have finished the debt schedule. It looks like we're on track to get into starting evaluation on Thursday. Good. No test Monday. I pushed it back 1 week.